Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Mark Niznik of Artemis, an accomplished fund manager. So welcome, Mark.
Hi, good to see you, Paul.
Yeah, we've got quite a few cross currents going off in the markets at the moment, not least the ongoing war in Ukraine. We've got the Middle East crisis. But on the other side, we have seen a fall in inflation right across the world, plus interest rate expectations are also expected to sort of come down as well. So putting all that together, what's your sort of like outlook, just broad brush, for equities going forward, and particularly in the sweet spot of small caps?
I think, Paul, if I step back, first of all, Will and I, who run the fund at Artemis, we're very much stock pickers. So we don't really have very strong views on the macro, but it seems to us as though the UK as a whole has been out of favour for quite a few years now, and small caps underneath that have been out of favour as well. So the valuations of the companies that we're seeing look to be extremely attractive at the minute. So I mean, I suppose the macro backdrop has been one of fear of inflation, fear of recession, for the last, 2 years. I know we've had a kind of a technical recession with the last GDP print, but I suppose the economy's been bubbling along fairly muted for the last year or so, but there hasn't been a recession. And yet our perception is that many investors have been discounting a big recession. So we actually, when we're meeting our companies, we're not seeing those kind of recessionary warning signs coming up. Most companies are still positive. Employment is good. Management teams are confident about the future. So we're seeing this as a really good buying opportunity because prices are so depressed. Yeah, in our kind of small mid cap land in the UK.
Yeah, that's a nice sort of risk reward balance, isn't it? If you're buying an asset which is priced to in a recession, but we're not actually going into a sort of like a really hard landing, then it's a good environment. Plus, we've obviously had lots of sort of like move to passives, which is just sort of artificial flows and sort of like attraction. The Mag 7s just attracted money, which seems to have sucked money out the small cap sector, and eventually that will turn as the cost of capital comes down and as people see value in this area.
I think that's what I'm hoping that's true. We've certainly built a career on that assumption. I suppose from the passive risk, small caps is one area where I really think active management can demonstrably add value. If you look at the average, the medium small cap fund over the last, it works on many, but the last 20 years or so, it has beaten the small cap index by about 1%, I think, and that's after the fees that the funds are charging. So in small cap land, even the average fund demonstrably adds value, and I think that's because as you go down the market cap scale and things get smaller and smaller, there's kind of basically less money to be made if you're an investment banker because the numbers are so small. So there's fewer and fewer people looking at this area, and therefore the opportunity to find a mispricing is easier. So it's a kind of a I wouldn't want my investment my investment director hearing this, but it's actually an easier index to actually outperform than the large cap index, which is much more kind of competitive.
Yeah, we'll keep this video from your investment director, otherwise you might not get a bonus there, Mark.
Exactly.
Well, let's kick off with one stock, just sort of like exactly in that space, which is Beeks Financial Cloud, which is basically, I think, is a sort of like a cloud provider for capital markets firms, so people like interdealer brokers, fund managers, traders, etc. And it provides a sort of unified platform to allow high frequency trading and sort of like execution across multiple exchanges around the world. I guess it's a one-stop shop for these guys, but just can you take us through this, because it seems to be on a real roll. It's won some good contracts and the shares have really taken off over the last 2 or 3 weeks.
It's been, so if I rewind, so it was an investment we made or a couple of years ago. I think it was on the back of a broker recommendation. It's a relatively small company. It's kind of 100 million market cap-ish, I think, now.
Yeah.
It was started about a dozen or so years ago by its founder, Gordon, in Glasgow. We had a couple of meetings with them, spent some time, went over to the head office a couple of years ago. Well, what they do is, I kind of, in my kind of layman's terms, it's kind of a business in a box. So they basically get a computer server, they package it with their own proprietary software, and that kind of box they then put in an exchange, could be anywhere in the world, and it allows typically hedge fund customers to basically start up a business and run their hedge fund using the software and the box. And it's for they especially are good at very low latency, so very fast, quick dealing. When you're dealing, in nanoseconds, I suppose, you need to be close to the stock exchange where that trading has taken place. So their box allows the myriad of hedge fund and other clients to trade, whether it's currency, crypto, equities, bonds, very quickly and with very low latency. And they've been winning, as you say, quite a few contracts. They started off with smaller hedge funds and other companies, but in the last year or so, they've been winning much bigger contracts. And they announced, what was it, a week or two back, that they've won their largest ever contract and an American exchange. And for me, this is a company. Look, we bought it a couple of years ago. The shares didn't do very well for a year or two, and then they suddenly spiked up by about 50% or so as you said, after this announcement. The valuation is on, I think the shares are on about 17 times next year's earnings for a company that's growing
probably
at 25, 30+%. The free cash flow yield is about 3% or so. So it's a relatively full valuation, but the company's growing very quickly, and it's evidencing the business model by more and more customers winning and giving them business. And we like the model because it's a kind of a SaaS. So they basically rent out this server box on a monthly fee basis. So as long as those clients are still in business, they need that server that Beeks provides them. They're going to keep on paying the bills. And it was quite telling to us that with the kind of bout of inflation that we had last year, they were able to put their prices up to their customers and didn't get anyone kind of cancelling their subscriptions of note. So to us, it's a small kind of, it's probably riskier than many of our investments because it's relatively illiquid. I think Gordon owns a big stake in the business, but we see it as quite a niche, fast growth business that is, and the evidence is there from the contract wins that they've had.
Yeah, I would agree. I think the customer endorsements they've got there says everything. And as they get bigger, they get that scale and the networking effect. Because if I was a prime broker or a hedge fund, then I would want sort of like low latency connectivity across every single platform, whether that's OTC or on exchange, at the touch of a button to do my arbitrage or whatever like that. And these guys seem to be the one who's that focus and that expertise. So, and as they get bigger, then the cost dynamics get much stronger to stop anybody else coming in. So, I'm with you. I was always questioning on the USP against the big hyperscalers, but actually, because they have unique focus on capital markets in this area, then it gives them that real USP and differentiation. Okay, let's move on to another one in the. Well, this is the translation software business, RWS or R. It's in sort of like services and software, but it allows companies to sort of like translate in their websites and also patents and any sort of like regulatory filings and this sort of stuff into multiple languages, and to file them and to get them really sort of localized and customized. It's amazing how cheap this business is, actually. I was just looking at it, and it's on about less than 10 times PE, plays a good dividend, doing a £50 million stock buyback. It looks too cheap at the moment for somebody to sort of take this one out. But I guess there is some sort of like there's a rubber associated with this, isn't there? There's a catch, and I'm not sure what it is.
I think the catch is probably fear of AI threat. If I rewind, we got into this stock from a holding in a software company called SDL, which RWS acquired a few years ago. Now we've known both companies well since they floated on the stock market, so many years. And for us, the combination in theory was a good one. You had SDL providing the software to enable corporates to translate their websites, their manuals into multiple languages globally, and do it very efficiently. So that was the kind of software bit. And then RWS provided the kind of I suppose the mince to the grinder. They provided the customers with the patents and the words that needed translating. So the combination of the two we thought was powerful. Now, what's happened in the last 2 or 3 years? You've had the kind of the COVID tech boom, and then the post-COVID bust, if you like. So there's been a huge downdraft in technology spending.
E-commerce in particular.
I'm sorry?
E-commerce in particular,
exactly.
e-tailing.
Yeah, so a lot of the clients of RWS, who are the blue chip clients globally, including those top 7 that you talked about earlier, they have reined back their spending. So that's one thing that's hurt them. Therefore, they've been downgraded. Shares have been weak. And on the other hand, investors have been very fearful that the whole business of translating text will be done much easier and more efficiently through artificial intelligence in the future. So there's this kind of cloud of AI threat hanging over the shares. And as you said, therefore, the shares have been put on a very low rating. The free cash flow yield is double-digit, single-digit PE ratio.
And is this discount justified, Mark? When there's this AI sort of like victim discount, is it actually sort of warranted at all?
So I would say, if I'm being honest, Paul, I would say the jury is out. The company did a capital markets day last year to try and get over the message to investors that they were just as much a beneficiary of AI, and they use artificial intelligence to improve their software so that their translations can be better, cheaper, faster, as much as it's a threat. Now, what they didn't do was to put any numbers on that. Now, at a previous capital markets day, they put on, I can't remember what it was. It was something like mid-single digit revenue growth in the medium term, and put operating margin targets around that. They didn't do that with this recent capital markets day, and I think that got investors worrying. Where's the numbers for us to hold you to account to? So, for me at least, RWS is a little bit of undecided. The shares look very cheap. They look good value. The track record is good. What they say is being rather skeptically taken by investors at the minute. So I think we're slightly undecided. Well, I'm not totally sold on that the AI threat is not there and real, and it's more than they think. I want more data, I suppose, so we want more time. So it's still a holding in the fund. and the valuation looks compelling, but it's not one that we've been adding to. Normally, when share prices weaken, we kind of add to our holding. But this one, we're a little bit more nervous, I would say.
Yeah, we'll probably wake up one morning, one of two things. Either private equity's taking this one out at twice the price because it sees the value and wants to do a buy and build, or alternatively, somebody like Microsoft with its Nuance translation software suddenly decides to offer that to all of its, its AI customers worldwide, or its cloud customers, as just wraps it all in. There'll be one of the two, won't it? It'll sort of like there'll be a move, but either way. Okay, let's move on to another one, Eckoh, which is basically, I think, a sort of like a software provider for call centers that allow people who take calls for sort of like credit cards to be able to mask the details of those credit cards from the actual person taking that call and taking that transaction. And it looks a really nice, strong business. The only sort of like big question is, where's the growth going to come from? Because call centers seem to be downsizing, if nothing else, probably because of AI.
So I agree. So this is it's quite a small holding in the fund. On the one hand, as you say, when you phone up a call center and you want to buy a product, then rather than giving your credit card details over the phone to that agent, where there's a fraud implication, the agent can then switch over to the software that Eckoh provides, and it does it in a safe environment, both for me as the customer and the company with regard to its call handling agent. Now, they've been winning new business. So to me, the things that we look for in an investment is recurring cash flows, cash generation, and hopefully those cash flows growing into the future without a big capital need. Now, whereas Beeks, we talked about, has that, Eckoh has yet to really demonstrate that the new business that they're winning is showing in strong cash generation. That would be, to me, that's the weaker part of the story. Yeah. But they are winning new business, especially in the States, which is growing quite quickly. But they've yet to translate that into consistently strong cash generation. Hence, it's a modest holding in the fund.
Yeah. Okay, well, let's move to a really big holding. Let's go to Mears then, in sort of housing. They do sort of like look after a lot of sort of affordable housing, I think, housing associations and stuff, the repairs, the maintenance, the upkeep, and all this sort of stuff. And I think it's very, very, it's on about 11 times PE. Margins are quite slim, sort of mid-single digits. What's your latest on this one? Because, it's got a good solid balance sheet, presumably good visibility, and there aren't many competitors, I wouldn't have thought, in this, certainly not national ones anyway.
So there are many, many competitors, but few national ones. Yeah. So Mears is by far the largest social housing maintenance company in the UK. So what they do is basically they go around housing associations and council housing estates, and they fix dripping taps, doors, any of the day-to-day maintenance that they do under contract with the local authority or the housing association. They typically do that for a 5 or 6% margin. It's typically a cost plus type arrangement, very long term, so 10 years or more. And as you say, this affords them very strong forward visibility to their earnings. Again, their cash flows are coming in month by month. They're by far the strongest in the UK at a time when one or two of their national competitors have had issues. I suppose most notably in the stock market, Morgan Sindall have been trying to compete with them and got a bit of a problems competing. We also own Morgan Sindall, so it's quite interesting to see the two. Now, Mears have had multiple upgrades to their earnings forecasts in the last year. As you say, their balance sheet has been very strong. They've it's something like, I think that the market value of Mears is about 300 million quid from memory.
Yeah, 340, and they've got 75 million of cash, net cash.
Yeah, so they've given back about 50 million of cash last year in the way of kind of ordinary dividends and share buyback program, and they're going again with the authority to have another share buyback program, because I think they see that they've got excess capital without the need to invest it, and their shares look very, very cheap. So to us, it's our biggest holding at the moment.
I guess this is a sort of like sleep at night safely type stock, because we've got secular growth trends. I mean, just here where I'm in Birmingham, there's literally millions of houses that need upgrading and improving over the next 10, 15 years, whether that's sort of like, decarbonisation, improving energy efficiency, just better drainage, sewage, all that kind of stuff. There's masses and masses of work that needs to go onto properties in the UK. Yes,
I think if I can take two things there, I mean, just to have a balanced argument. So during COVID, they were very badly hit. In that, when we had the lockdowns, where their engineers were prevented to go into people's homes, so they couldn't do anything, and the shares fell very badly. But when COVID passed, they rebounded. So that was one thing. So to me, they're normally very recession resistant, because their revenues are ring fenced by the local authority and housing associations tenant rents. But you mentioned an interesting point here, which was the decarbonisation. If the government in the UK was ever serious about trying to decarbonise, then Mears looks after hundreds of thousands of properties, residential properties. Residential property, I think I'm right in saying, is the largest emitter of carbon.
I think it is. You're right, over 20%.
So putting, whether it's heat pumps, insulation, solar panels, if the government were to fund that, someone like Mears would be absolutely ideally placed to roll that up around the country, and they have the context, they have the skills to do that. And I would argue that's not currently valued in the share price, but it's a kind of an option. Now the trouble is, it needs funding, and it's a big number that the government would have to subsidise the local authorities and housing associations to come up with. But it could happen in the future.
Yeah, I mean, it's certainly not in the price at 11 times PE with a strong balance sheet. There's no doubt about it, and a 3.5% dividend yield. And I think also with smart meters already going in, which allows two-way electricity from households, then it's only a matter of time before it happens. I mean, it's happening already around the world. So you're right, the funding, but it should be in theory a when, not if. Okay, well, let's move to another one into sort of the housing sector. Henry Boot, and he got a bit of a kick in, unfortunately, just recently. Came out with a trading update and a bit of a profit warning going forward, which actually is against the grain for most house builders, because we have seen some sort of improving outlooks for the next year from all the sort of the major ones. We've had that big sort of like deal between Barratt's and Redrow. But anyway, coming back to Henry Boot, what they said was that because they have a land development or selling business, then they were seeing extended payment terms, I think, from their land creditors, from some other large house builders, which would increase their debt, hence increase their interest costs, and then lead to a PBT, a bit of a PBT hit. So what's your sort of outlook here? It seems like a bit of a short-term temporary thing, but what's your thoughts?
So I would agree. So if we rewind, the thing that attracts us to Henry Boot is the core Hallam land business, which is the land. So what they do is they basically buy land throughout the UK, go through the planning permission process over many years, and get the planning permissions, and then sell that land with planning permission to the major house builders, to the likes of Redrow, which we own actually, and Barratt and etc. and they've been very successful in that business for many years. They have, I think it's something like just under 100,000 plots of land in their land bank that, rather than valuing at the current market value, Henry Boot has a policy of keeping that value at cost. So they've got 100,000 near enough plots of land valued at cost that have been accumulated over the last 10 to 20 years that should have a huge markup because of the land inflation that we've seen in that time. And yet the shares are valued on a, so to me, it's more of an asset valuation. It's not a PE kind of free cash flow. It's they're on a, I think currently a 35–40% discount to the current net tangible asset.
Yeah, net tangible assets just over £3, traded at about 190.
Right. So but that asset value, to our way of thinking, is substantially undervalued because it's at cost. It's not at current market values. When you look at most property companies, they value their assets at current market values, and Henry Boot don't do that, and therefore the kind of, to get an apples comparison with other property companies is quite difficult. Now to me, that affords us protection as long-term investors. So I would absolutely agree with you that this looks like a short-term issue, because house builders have been reining back because of the lower sales rates they were seeing from last autumn to fairly recently. They've been reining in their land buying, and that's meant fewer deals crystallizing for Henry Boot. So to me, that says nothing of the medium to longer term potential, because if you're not selling the land today, you're selling it tomorrow. Yeah. So to me, that's not particularly negative. It's a nice thing for the headline writers to write about Henry Boot getting the boot or whatever it is, but it's not a long term negative.
But wasn't the extended? It was extended payment terms on capital on the creditors, so they've actually sold it. They just haven't got the money in. I presume that's because of milestones. They've structured the deal such that it's presumably when the house builder who's buying that land actually breaks ground, I presume, and that's why there is an extension of the payment terms, because they were expecting it to happen sooner rather than later.
I would say there's a variety of terms that they have. Deals can be with various farmers who, Henry Boot would pay them on a planning permission being granted by the local authority. If you speak to many of the virtually all of the house builders will say the planning system in the UK is at its most fraught that they've ever seen it. Delays are endemic. It's very difficult to get planning permissions, to get the local planners to have the meetings and come back with agreements. So planning has been a big issue, and you've also got interest rates rising. So the cost of debt is, far from being zero of a few years ago. It's now more significant. So you're paying 4 or 5% on your money.
Okay. All right. Okay. Well, let's move on to the second largest position, which is Wilmington, which came out with some pretty impressive first half results. Shares have sort of like just really consolidated at the current level, but they were saying organic growth about 7%, EPS double that of the growth, and they sort of like offer software and information services into all the regulatory areas, governance, compliance, and all this sort of, particularly I think into healthcare and to financial services. What's your sort of like latest on this one? I'm guessing it's just really run the winners, because it's been a bit of one of those horses that's just done really well.
It's one, I think it's a good example of a COVID lockdown stock that massively improved its business model. So this is a company that we've known for many, many years. So they are the global market leader in training compliance officers for big financial institutions, and they used to basically fly their trainers around the world and have classroom like meetings, whether they be in client offices or at hotel conference centers, to train those compliance officers, who would then go on to train their own staff. And then when COVID lockdowns and the kind of flying bans basically stopped their entire business, they very quickly transitioned to offering digital training, having a meeting such as we are now on the telly. And they were able to do that very, very quickly and avoid the expense of flying their people around the world. So and putting them up in hotels, but at the same time they were able to maintain their pricing with the customers. So that was a massive improvement to their business model. Their costs were reduced, so therefore their margins were higher, and the customers liked the kind of flexibility of training online. And since then, their business has gone from strength to strength. So the organic growth for Wilmington a few years ago was pretty lackluster. I mean, plus or minus, not very much, and it's steadily grown. As you say, the figures that this morning showed 7%, I think.
Yeah, it was organic
currency revenue growth, and to me, that is pretty attractive when that revenue growth is coming through in high margins, very little capital needs, so it comes through in that cash generation, which we look for. And I think something like nearly 3/4 of their business is, if not recurring earnings in the kind of SaaS sense, but repeat revenues. So they're going to come back year after year, and the shares to us look pretty attractively valued. So I would agree with what I think you said. Run the winners. So it looks very attractive. It's one of our big holdings. The shares haven't performed. They've done okay, but we still think it looks attractive.
Yeah, I would agree. I mean, I think it's a good sort of rule of thumb, I think, for investors when they look at sort of valuation and a company that has done really well. I mean, it trades on about 15 times PE, but it's got a shed load. It's got about nearly 30 million or 28 million pound of net cash on its balance sheet, 300 million or so market cap. But when you do it through the lens of a PEG ratio, then it comes down to about 1. And so for a high recurring revenue company generating very good profit margins of 20% and good cash generation, then you're crazy to sell a jewel in the crown like that, aren't you?
It's funny. I used to, at the start of my career, so you could probably tell by my wrinkles, I've been doing this a long time, 30 odd years, but I used to look at a PEG ratio of under 1 as a kind of a litmus test for a good valuation. But I would say in the last couple of decades, we've really honed the valuation part of what we're looking for much more to a free cash flow yield, because a PEG ratio is a profit. Profits can be fiddled. Profits can be fiddled by capitalizing costs, by changing depreciation rates, by excluding certain costs, any number of ways. Cash flow is much more difficult to fiddle, and so we focus on companies with high free cash flow yields with recurring business model. That's our ideal. Ideally, it's a market leader with a high free cash flow yield with a recurring business model that doesn't need huge capital to expand. That's what we're looking for, Will and I, when we're having our meetings each day.
And do you adjust those cash flow numbers to normalize them as well, Mark? Because you fall into that trap as well.
Absolutely. I mean, cash flow can be fiddled on a short-term basis. So a bit like you were saying, you can not pay the bill for a few months, but if you don't pay the bill, eventually people will stop giving you the service. So you can stretch it so far, but it bites you in the bum the next time. So that's why we pay particular attention to cash generation. We look at profits as well, but to me, the cash flow of a company is the thing that keeps the profits kind of right, if you like. You can fiddle the profits very, very easily. There's been, especially in small cap land, there's so many examples of companies. Fiddling is maybe a bit of a harsh word. Companies taking aggressive accounting stances.
I must admit, I'm a bit more sort of. I get it. Definitely, cash flow is the most important. The only issue you get with small cap land is that if you've got a growing business which has a high return on capital employed, you don't want to restrict companies from investing in themselves. And if you just sort of nail, cash flow yield, then they don't invest in R&D, new products, and this sort of stuff, or expanding abroad when there's a market opportunity, which has been a bit of a criticism over a long period for UK compared to the US, who've just been like gobbling these things up. And yes, they have a lot of problems, but actually, when they scale international businesses, they do it right.
So I couldn't agree with you more. So to me, part of our analysis is when we're meeting the companies is that cash flow a product of reduced R&D or cost cutting elsewhere, and therefore not sustainable, or not? And to me, that's part of our job when we're interviewing the management teams of companies.
Good. Okay, well, let's move to another one in the IT sector. It's basically FDM Group, which I think does sort of like it provides sort of IT outsourcing resource, people into businesses, into corporates, into the public sector. It's got this famous Mountie sort of like training program in-house where it recruits, I think, young people into the business out in Northern Ireland, trains them up, and then puts them out as IT consultants or just implementers of IT systems and the digitization transformation. Not surprisingly, we had a boom in all things IT, sort of like in 2021, 2022, and then the 2023 was really sort of like people were cutting back on discretionary spend in corporates, and they got hit and they've had to downsize. Can you give us your latest thoughts on this one, where they are in the investment cycle and how you see that? I guess, given they've downsized, and there's probably quite a bit of cash coming out of this business.
So it's quite a good proxy for general tech valuation change, I would say, this one. So it's a company that we've invested in the past. So we've known it since its IPO many years ago. I was particularly impressed. So rewind. What they do, as you say, is they take on graduates from university. They intensively train them with the latest computer language skills and technology skills, whatever's in demand to their corporate.
AI, cybersecurity, digitization.
Lots of languages I don't really understand or know about, but they thoroughly train them, and then they place these new graduates as consultants with their corporate clients, and then they stay with them a year or two or more. The clients can then take them on as permanent staff or transfer them out, and so they allow the corporates an easy, flexible way to get technology expertise into their businesses. They've been doing this for a very long time. I've been particularly impressed where during the financial crisis of 08, 09, FDM managed to avoid having a profits warning. With their customer base are typically big banks, investment management companies globally, and with that kind of financial kind of near meltdown in 08, 09, you would have thought a company providing that technology service into that customer base would be really badly affected, but they weren't. They've got a very strong business model. Now, the valuation of the company's shares in the 5 or 6 years before the kind of latest interest rate rise a couple of years ago got to a very high rating. And then the last couple of years in the kind of technology downdraft, where people, as we spoke about with RWS, have kind of reined in their tech spending, FDM have seen that kind of chill in the air, if you like, and they've had fewer mounting demand, downgrades to their profit forecast, and we've come in and we've bought a modest holding a year or two back, which we've been increasing recently as the shares have been fairly weak. I would say that the company is still of the belief that they can grow double digits, medium to long term. Again, that's their long-term track record, but the current environment is quite tough for them. So we would see them at a kind of a low point caused by the kind of reticence of spending by their customers, but it's likely to be temporary. And Will and I take a 3 to 5 year view, and a little bit like our thoughts with COVID, we think that the technology spend will be ramping back up within that 3 to 5 year view. Therefore, we've been adding to the likes of FDM, others, Next 15, GB Group, Future. We've had another number of technology shares that we've added to in this lull that we've seen recently. Yeah.
Well, it is. I mean, it makes a 6% yield. So, you're getting paid, but while you're actually waiting, what is their sort of USP against the sort of the other IT outsourcers, whether that's sort of the Capgeminis or, basically the IBM Global Service? I'm guessing it's a lower price point in terms of if they've got graduates, it's sort of like people who have in their late 20s, people who are really experienced and, they're not the big heavy hitter sort of rainmaker type guys that are very expensive that you get for outsourcing companies. These are more sort of like people who are going to be, a bit more budget orientated, I guess.
I would say that they are very close to their customers, so that they talk to the tech departments of the big banks and asset managers and know exactly what they want and what they will be wanting in a year or two, and they are very fleet of foot in training those grads in the actual technologies, the languages, the software languages that they expect their clients will want in a couple of years' time. So they're able to offer very, very good flexibility to those customers. So to me, it's the flexibility and knowing that being very close to the customers that's their USP.
Tailoring the services. Okay, well, let's move to another one you've added to. You said GB Group, which basically does identity management software for lots of e-commerce companies, but also it does for sort of gaming and gambling and financial services and all this sort of stuff. And I guess it should be, in theory, a massive beneficiary of AI, because we have now seen a huge sort of like increase in deep fake impersonations. And therefore, when it comes, if you're a retailer, I don't know, you're somebody like M&S and you need to be able to securely to take a transaction from somebody who's claiming that they're Paul Hill, then you've got to make sure you check all the details. So they should, in theory, be a big beneficiary. But the shares have come off a lot since their 2001 high. They came down to about, I think, at £2, and they're about £2.80, £2.90, which I guess is because you guys have been buying.
I'm not sure we should move the dial much, but so this was a business that we've invested in 10, 15 years ago on the basis that it was a global leader in verifying the identities of people who were doing business online, and that was a growth market. So to me, that's still structurally a long-term growth market. And as you say, it's a little bit like a war. There's GB and similar companies trying to stop fraudsters, and fraudsters are using ever increasingly sophisticated techniques to try and thwart them. So it's kind of like an ongoing challenge for them. I would say that in that period of ultra low interest rates from the global financial crisis to the end of 2021, the share prices of many tech and growth shares got elevated to levels that weren't sustainable. And I would include GB Group in that. I think it was 2021 when they bought a competitor in the US called Accurant, which is a good fit. They do document verification. So GB do the online verification, Accurant do the document verification, and they paid something like, I think it was 65 times the operating profit of Accurant in 2021. And they part funded it with GB shares, which were very highly valued then. So it was a deal that was kind of rang the bell for the kind of the valuation peak. And since then, you've had the kind of post-COVID. So as more business went online during COVID because people were forced that way, GB had some extra supernormal.
And crypto, I think, was another booster.
And crypto. And then since then, in common with the FDM and RWS and others, there's been a kind of a reduction in demand from those customers. And GB have had downgrades to their forecast earnings, as well as a derating in the shares from that high level that they used to fund the Acuant deal. And in the last couple of years, it's got back to a valuation that we thought looked very attractive again. So we had sold our shares too early, in fact, probably a couple of years too early, and the shares zoomed up. But we've bought them back now, probably again too early. But we're starting, a little bit like FDM. We see the long-term growth as in online verification as kind of a structural growth.
Yeah,
it's a matter of time as to when it's a secular growth. So it's a matter of time when it comes back. We're seeing maybe green shoots at the minute, but so far we're not seeing kind of upgrades to forecasts or earnings momentum or anything like that. But the valuation of the shares is now vastly different to what it was 2 or 3 years ago. So it's the same company, but with the valuation being massively cheaper, and then still having a strong balance sheet and a good global market position. So we're kind of keeping the faith with GB.
And there's huge barriers to entry to get into this market. I think they're only one of 4 worldwide. Expedia and people like that do similar sort of services, but there's nobody who's going to basically just outsource their ID verification to a new startup, because unless they've got the track record and all the data behind it, it's just going to be a license to get for theft otherwise. So
there's an interview with the management on our website, actually, if any of your readers.
Okay, good. We'll have a look at it.
Similar with Mears and a couple of other of our companies, just highlighting what the USP is for that company.
Okay, well, just turning to the similar sort of sector in cybersecurity, we've got NCC, which has been a sort of perennial takeover target for quite some time, but the shares have, again, really been sort of like flatlining to sort of, they've been going a bit recently, but they've got 2 parts of their business, a cybersecurity type consultant, so managed services element, which I think they bought some time ago. And then they've got this sort of core cash cow, which is this software escrow business, where I think they take software from developers or from corporates and then put it into a secure vault. And if they get sort of hacked or they get sort of like cybersecurity, then you can redeploy it. And it's essential sort of backup sort of stuff of their applications, not of their data. So we'll take us through this one, because it seems as though both parts of the business don't really have massive synergies. So there may be an unbundling opportunity there. And then really the sort of thoughts of the sort of, the secular growth in cybersecurity consultancy and managed services, which is different to the secular growth in the software for cyber.
It's an odd company. It's been through the ringer, to say the least, in terms of its history, its management. It's one that we've followed for many years. I've always loved the software escrow business.
Yes.
As you describe it, it's basically like an insurance policy. So you as a corporate with a critical piece of software that you're relying on, it gives you the assurance that if that software vendor goes bust, you can still take the code from that bank vault and allow your business to carry on with that application. So that's the kind of core of it. Now, very few customers actually do go bust and need that. So it's a very high margin business with very little capital need. It's not particularly sexy or growing, but the cash flows are absolutely prodigious and recurring, and that's what
and it's good pricing power.
But very good. Yeah, absolutely. You're paying a few £100 a year for this. So whether it's £10 more, it doesn't matter to typically the big corporates who are buying this service. So for us, we've always liked that software escrow business. The sexy part of the bit, sexy in inverted commas part of the business is the cyber security. So the kind of it's a bit like Neo in the Matrix, trying to kind of to come up with new ways to thwart, get
exactly
people's cyber security, and there's no doubt that is a growth market, as we talked about with GB Group, trying to hack into corporate websites, corporate infrastructure is big business, and the cybersecurity part of NCC provides consultants who advise customers how to best set up their business to avoid that. Now, that is a very different business model. It's a consultancy, it's a people business, it's a selling time, a day rate, hourly rate of people to that business.
And there's some pretty ferocious competitors in there, your IBMs, all your accountants, the consultants and all this kind of stuff.
Absolutely. And they've also, so NCC have again been caught by this downdraft in tech spend, and therefore they've been faced with profit downgrades, profit warnings, and short-term trouble. Now, one of the benefits of having a consultancy business is that it should be very easy to cut your cloth to suit demand. So to me, it's not something to capitalize up the poor performance currently of that tech consultancy business, because they can downside, they can basically lay off consultants to suit the anticipated future demand very easily. Their main issues have been in the States, where it's very cheap to get rid of people. Now, to me, that allows that business to have the prospect of better future performance as they cut their cost base to meet the expected future demand. So I think people underestimate NCC's ability to reduce their cost base in that cyber business to meet the future demand. So we think that's an underpriced valuation. You've got the great cash flow of the software escrow business. You've got the currently very depressed profitability of the cyber business, but that's not depressed in perpetuity when tech spending comes back.
On that consultancy business, though, I mean, how much is recurring revenue? I'd say all the managed services should be, but your consultants must be sort of like more, sort of implementation, project orientated.
It's a mix. It's quite a lot of project. You have similar customers that use their consultants for different projects. So I would say it's not of the quality of a GB Group, a Beeks, where you've got a contracted revenue, or at Mears, where the contracted revenue stream. This is selling your body effectively to the similar customers. Yeah.
Okay, good. Well, we'll move away from selling our bodies to other people.
I didn't phrase that very well, did I?
It's all right, don't worry. I got the gist. Okay, let's go to sort of like in the financials. We've got Secure Trust Bank, which is actually a favourite of Lord John Lee of the Financial Times, and it's amazingly cheap. I think I was just doing the numbers. I think it's got a sort of like a net tangible or net asset value of, I think it's about sort of £18, and it's trading at about just over £7 currently. And of course, it does sort of specialist lending to, I think, buy to let and to real estate, but also has got caught up in the PCP financing for cars. And I guess the big discount is, how much is that with the FCA investigation over those sort of like, the loans and potential allegedly mis-selling across the whole industry? How much is it going to cost? But given that if that wasn't there, then it would be a slam dunk. But Close Brothers last week also came out with a bit of a shocker in this area, didn't it? What's your sort of, I mean, how do you treat this? I mean, it's a high risk, high reward, I guess, at the moment.
Yeah. So if we rewind, so I would say, when we say we look for market leaders with recurring cash generation, banks is a specialist area that's kind of, it's more tricky for me to find value in the banking sector to try and judge what the unique selling proposition is. Now, with Secure Trust Bank, it's in a number of areas. The largest area and the area that attracts us is in their business V12 Finance, which provides mainly interest-free loans to the likes of retailers, whether it's sofa retailers, watch retailers, a number of sectors. And what we like about that is that most of those customers don't actually need the interest-free credit. They're just taking it because it's offered to them as an incentive by the retailer. So therefore, the default potential for their customer base is much reduced when looking at other forms of lending. When we've checked out the V12 offer with some of those retailers, they have given us very good feedback on the ease of use of their offer. So
it's trade finance, is it? It's working capital, effectively.
Interest-free finance. So if I'm buying a sofa, if you're buying a sofa at
DFS, I see, right, okay.
And you're offered an interest-free deal, but there's no discount for offering a cash deal, then you take the interest-free deal.
Gotcha.
V12 might be one of the companies that offer the loan of that interest-free credit to you, and you're a good
to the individual, not to the retailer.
To the individual, yeah.
Yeah, okay.
So to me, it's as you say, the shares are trading on something like a 60% or more discount to the net asset value of the company.
Yeah.
The management have a medium-term target of a 14 to 60, mid-teens return on equity. That doesn't marry. If they can do a 15% return on equity and the shares are on a 2/3 discount to the tangible asset value, that looks good value. Now, I would say the recent FCA investigation into discretionary commission arrangements for car finance is the shares were already on a 60% discount to now before that came in. I think what Secure Trust Bank have said is that the lending that they've done, so the vehicle financing business is a small part of what they do.
Yeah.
And the discretionary commission arrangements was, I think they said, mid-single digit.
That's correct.
Of their book. So it's a small part of a small part.
Yeah.
How you value the risk of that is very difficult to say. That the FCA haven't said what the what compensation arrangements or levels of fine, if you like, or they're going to put. They've just said that they'll investigate and will report back later this year. So it's very difficult to put a number on that. But it's a small part of their business. But it needs monitoring there.
Yeah. Yeah, I mean, it's a classic sort of like investment conundrum that a lot of people come across is, do you invest on the sound of cannons? And they've had a couple of big blasts of cannons, but we don't know the actual outcome. And just looking at the numbers, I mean, it still pays a sort of 6% dividend yield, trades at 3.3 times forecast PE, so and a 60% discount to net. So there's a lot of bad news already in there. But hey, if you don't know what the potential outcome is, then that's why people have sort of stepped away, I guess. But for people with broad shoulders and risk tolerant, then there's definitely value. Another one in the sort of banking sector is Vanquis Banking, which I think is sort of like a subprime lender to individuals across the households across the country who can't get normal sort of banking terms, etc. So it's got a pretty high net interest margin, etc. Do you want to take us through this one? I think the net tangible book is it's not quite as big a discount. It's 176, and the price is about 135. So probably roughly around about, I don't know, 30% discount.
Yeah, sure. So this is, again, a modest holding in the fund. It's a company we followed I followed it for 30 odd years. It's the old Provident Financial that's been renamed. So
is it? Oh, okay.
Their core business used to be doorstep lending, and that entire industry was basically closed down by tightening or changes of the rules by the FCA, and they put their business that Provident were the biggest, or Vanquis were the biggest in that market for many years, and they basically put it into runoff and closed it down. And what sparked our interest was the PRA allowing Vanquis, or Provident as it was, this was about a year or so ago, to have less capital with them as kind of lodged with them, i.e. the PRA saw Vanquis as a better risk business. And to me, that, your relationship with the regulator in banking is very important. It had been in times gone by less than brilliant, but was improving. And their core business, which is the Vanquis credit card business, as you say, which provides credit cards to people who have, impaired credit history, at a time when many competitors have been pulling out, and there are fewer places to go for people with poor credit records. That looked to me to be interesting, and so we bought a holding. Since then, so they've got two businesses. The Vanquis credit card business is by far the biggest. They've also got a vehicle finance business called Money Barn, which and with regard to our previous chat about the FCA investigation, they said that they haven't done any discretionary payments, and so they're completely kind of in the clear from that point of view. But as you say, that the shares look I think they're trading on about a 40% discount to their asset base, and they're similar to Standard Trust Bank, looking at a mid-teens return on equity, which again looks good value, especially when the regulator is seeing your business in a better light than it did previously.
Yeah, and also if we don't go through a sort of hard recession and people stay employed, then actually you're not going to get a hard credit cycle, and these guys should do absolutely fine. They've been through hard credit cycles before, so they've got some sort of resilience. Okay, well, let's move to another in that same set. The UK's largest pawnbroker, H&T, which has got its pledge book is going through the roof. It's doing really well, but it had a bit of a stumble before Christmas on its retailing side. Things largely on watches or something like that, basically these second-hand Rolexes and stuff. But you take us through this one, because it, again, trades at a ridiculously cheap valuation, sort of less than 7 times PE. Got a bit of debt, but you'd expect that because it's got its pledge book's growing so fast.
Yeah. So again, a company we've known for many years. So the key attraction, again, another example of a market leader in their niche market. So a pawnbroker allows lending of typically jewelry, so rings, watches, bracelets, typically gold jewelry is the kind of stock in trade. They would have a 6-month, typically 6 or 8 month loan, but the loan would be secured against that piece of jewelry. So what I like about it is that rather than get the risk of getting into a debt, if you're the customer wanting a loan, let's say your car has broken down, you need to fix it, money is scarce, but you have jewelry, so that will fix the car. 80% or more of the time, that customer takes back the piece of jewelry that they've pledged. But if they can't, and they are in financial difficulty, unlike other forms of lending, the customer cannot get into a debt spiral. So unlike the Wongas of this world with payday lending, where you
Amigo,
similar with guarantor loans, you don't rack up a debt spiral for the customer. So if I was sitting at the FCA, I think I would be much more relaxed about lending in the pawnbroking sector, because the customers aren't able to get into that debt spiral. The worst that can happen to them is they lose the item of jewelry that they've pledged. So, okay, they pay a high interest rate for that, but so from H&T's point of view, it helps with the customers. They don't get into a debt spiral. The loan is completely secured, so they don't have the unemployment risk as you do with other forms of lending. And they are by far the market leader in the UK. at a time when the competitors have fallen by the wayside. So the Wongas, well, H&T bought the number 2 player when they got into financial difficulty, Albemarle and Bond. There's Ramsden's, which is a distant, second from them. So that's the core why we like it. They have run into a kind of so they grew their profits by something like 30% last year. It was supposed to be 40%, and the gloss was taken off by the jewelry sales being lower than expected, as you say. But to me, that's not the core reason why we own this company. It's that massively strong position in pawnbroking in the UK, in an area where it's secure lending, and it's an area that doesn't allow their customers to get into the debt spiral that other forms of lending could. So to me, that's a business that's very good quality lending.
I remember when my kids about 15 years ago, they're watching telly and Wonga advert comes on, and they say to me, Dad, why don't you get some free money from Wonga?
It's far from free.
Yeah, I know, exactly. Get some free money, Dad. They're offering it for free on the telly. Okay, well, let's move into the consumer. We've got Onthebeach, and this has been a sort of like an enduring trend where everybody's done revenge spending to go on overseas holidays. It seems to have really hit its strides just recently. But I guess the big question for investors is how long can this sort of like extra revenge spending for holidays continue, particularly for sort of overseas? So it's cheap. What's your latest thoughts on the beach?
So revenge spending, that's interesting view. So I suppose, hang on, rewind. So this was a company that we bought during the COVID lockdown period, where you weren't allowed to go on holiday, and so all of many of it. So we bought Onthebeach, we bought Jet2, we bought Hollywood Bowl. On the what we thought were depressed share prices that would mean revert on our 3 to 5 year time horizon.
Which is what's happened.
Which is largely what's happened, yes. So that's been handy. Onthebeach it offers they're an online tour operator. So they take flights from typically Ryanair, EasyJet and others, and they package them with holidays, with hotels in the Balearics and the Costas and typical overseas
package holidays, basically intermediary package holidays, guys.
Exactly, and they take a small margin for packaging those two things together and offering it as a service to their customers, and that's been so. Unlike Jet2, for example, that own the aeroplanes and have the risk of capacity, these guys don't. So it's a much lower cost, lower risk business model, but lower added value as well. I would say. So as you say, the shares have done very well. The company is seeing good demand at the moment, and I suppose we take the view that it's very difficult to judge the future demand, but I would have thought that going on a holiday is actually quite near the top of most folks' list of things to do with their discretionary income. And Onthebeach offers a good value way of allowing customers to go on holiday. So I suppose if I rewind, such has been the worry for investors that there will be a recession in the UK that will mean consumer stocks bite the dust. We're taking a slightly contrarian view. So Will and I are overweight consumer discretionary stocks in our portfolio. So typically the likes of Hollywood Bowl, Dunelm, Halfords, but I would include Onthebeach, Jet2, Fuller's, Wetherspoons.
I would certainly say their profits won't be at risk this year in 2024, not only because Ryanair and EasyJet are saying there's plenty of people booking for some holidays, but more so because the summer in the UK last year was terrible. And so I think everybody just decided, I'm not going to get absolutely soaked and wet in August. I'm going abroad this year. So, and it's good value. You're right. Okay, well, let's move. You've mentioned it a few times, Hollywood Bowl, and they're the sort of the UK's largest 10-pin bowling alley operator. What's quite interesting there is their biggest competitor, 10 Entertainment, got a private equity bid or taken off at about 8 times EBITDA. And I was just looking at Hollywood Bowl, and they're only trading at about, well, just less than 6 times EBITDA as well. So I guess this one is got to be a firm hold, isn't it, or something, I imagine?
Again, as I say, we bought it during the COVID lockdown period, followed it for many years. It is by far and away the market leader in the UK in 10-pin bowling. They have started expanding into Canada with the first steps of building some capacity there. They're also seeing fewer competitors for sites when they're looking to open a new bowling system, as the cost of capital has gone up, and a lot of their competitors have been kind of loss-making, debt-funded rollouts. When the cost of money has gone from 0 to 5 or 6% or more, that's clipped their wings a bit. And we're seeing that in a lot of our holdings, which are typically market leaders, that the chipping away at the ankles by startup competitors has reduced somewhat. So you've got Hollywood Bowl, market leader in a leisure area that actually doesn't require a lot of labor. So a lot of, unlike a typical pub where labor is what, 30-35% of the revenues, the 10-pin bowling is mechanized, and the labor content. So when you've got national living wage going up, their customers are getting that benefit of the living wage without Hollywood Bowl having to employ too many people that are requiring big pay rises. So that we think is a good business model.
Well, it makes 25% EBIT margin. So, I think you're right. Yep, good. Okay, we've got a bit of a harder one for you to give us an update on. The PZ Cussons, which a couple of weeks ago came out with a trading update. And I think it's UK business in sort of like, consumer sort of cleaning healthcare products, the Carex brand and Imperial Leather is doing pretty well, generating cash. But they've got a significant business out in Nigeria, and they had a devaluation of the naira there quite significantly, which I think really sort of like has ballooned out their debt, because I'm not sure exactly in terms of, they obviously couldn't hedge it, but presumably they had a whole lot of naira cash out in Nigeria. So the devaluation meant that their net cash became net debt quite quickly, because it became confetti rather than actual pound sterling.
Exactly right. So you've touched on this. This is a kind of a sore nerve, as it's been a poor performer within the fund over the last year. So this was a company that we invested in 2 or 3 years ago on a kind of a management change situation where the new management were going to concentrate on fewer of their core brands. They have a plethora of brands. You mentioned a few of them. There's Carex, the hand cream business. They've got Saint-Tropez, the bronzing,
tanning thing.
They've got Original Source. They've got Morning Fresh, which is an Australian or Asian washing up liquid leaders. They've got a number of brands where they are the market leader in that area, but they've also got a number of tertiary brands, and the management were putting more emphasis on growing the core, and that was going to mean a kind of modest growth, but at a kind of a 15% operating margin in the medium term.
Power brands.
Sorry?
Power brands. Reduce the SKUs.
I forget what they call it, but so that was the thesis, our thesis for investment. But they've also got businesses. It was a global business. They are particularly strong in Africa and Nigeria, and they have a business that not only does some of those brands, but also sells electrical goods. It's more of a conglomerate in Nigeria, and they've been caught out by the huge devaluation of the Nigerian currency, as you say, and that translates back into into much less cash for
UK sterling, yeah.
Cussons. So the shares have been under pressure by that kind of, first of all, the threat of that hanging over them, and then the actuality of the devaluation coming through. Now, to me, this was a risk that we knew we were taking when we invested, and we've been called on it.
Yeah.
But
haven't they been able to get that cash out of? It's been capital controls out of Nigeria, because the management team must have seen this one coming.
There's been a grey market, so you can get your
Right.
money out at the not at the official rate, but at the grey market rate. But that's a far different price than the official rate. So effectively, you couldn't get your money out at the official rate. So now you can, but it's much less valuable. The core to me with this business is, can their core power brands, as you say, thrive in a very competitive environment? And that, I think, we've yet to see that demonstrated by the company in the last year or two. So their core brands are doing better than the rest, but probably not as good as we'd hoped.
Yeah.
So to me, it's kind of another one that's a little bit on the fence.
Yeah, I think that Nigerian exposure has gone from being a real boon of 20 years ago when it was emerging market exposure, go days, to a real sort of like albatross, I think. And I don't know. I mean, if I was the FD there, I would have, you've got to look at innovative ways to reduce that risk for the corporates, whether that's the local Nigerian business buying assets abroad and bolting on, so you have assets, so which in a different currency. I don't know but anyway, that's all hypothetical. But you're right. It's sort of like good quality core business, and it needs to sort of like jumpstart its growth a bit, I think, probably. Okay, let's move on to healthcare. We've got Alliance Pharma, which basically is OCT healthcare products, but has also got 25% of its business in prescription drugs. This has had quite a lot of debt as bought, buy and build strategy, trying to pay off its debt, good margins. And I guess the question is, how do you see that turnaround going, the debt reduction, and also in terms of the prescription part of their business, what's sort of the pipeline and new products, and whether they have any patent expiries coming up?
So the core, the history of this business was with that OTC prescription business. So they basically used their cash generation to buy old, out of patent drugs that had kind of done that, and then were on that kind of tail of very low growth to no growth, but very high margin. And they bought those from big pharma companies, and they've got a portfolio of brands that you would go to for various ailments that you would get on prescription. And that was their core business, and that meant very high operating margins, very strong cash generation, little need for capex, but very little growth. And they used the cash generation to buy more of those assets. And then probably 4 or 5 years ago, they started buying more consumery brands. So they bought some brands. There's a dandruff shampoo, there's a knit shampoo, there's an anti-scarring product.
Yeah.
So they've gone from kind of OTC pharma to general or specialist consumer. And that has caused some bumps in the road. They've built the debt, as you say, but the share valuation looks very, very low relative to the cash that the company is generating. So the ability for the company to generate cash and pay down the debt, I think, is very, very high. There's also a CMA, a competition investigation over a pricing of a product that they used to own, that's hanging over the company and the share price, I would suggest. So to me, the last statement by the company was pretty good. They They made the revenue forecast and profit forecast that were expected, but they said that they were going to invest more in future development of their existing product base, which is exactly what we want them to do. So greater investment for growth in the future. So to me, this looks an undervalued stream of future cash flows that maybe it hasn't. Well, I think it hasn't managed its forecasting with the city very well, because you've had lots of downgrades to forecast. But the core business is a strong cash generative one that looks to us to be very modestly priced.
It's on about 7 times EBITDA. So when you compare it to the likes of Haleon and the other big OTC healthcare products companies, then they're on about anywhere between 12 and 15 times EBITDA. So yeah, you're right. It does look under. Okay, well, let's move to another turnaround, which is or more of a turnaround, is RM Group, which is basically educational supplies distributor, does IT, but it also does just normal sort of supplies for school, and importantly does a good high recurring revenue stream in their exam assessment division, which is doing digital assessment, I think both for schools and for sort of higher education. Lots of different moving parts. I think they've got a pretty much of a rock star CEO who's coming in, and they've just shut their latest. They've shut down one of their divisions, which I think they had a ERP issue with some time ago and couldn't get that one round. So it does seem as though they're taking they're giving the business the relevant medicine. And what's your sort of whether is this one moving in the along the lines you should expect?
I would rather you had not mentioned that one, but I'm happy that you did, because it's a good example of one of our cock-ups. So we've sold out of RM.
Oh, okay, right.
Last year. I would like to talk about it though, because I think it's
please do.
Productive. So
if you've only made one cock-up in your life there, Mark, you're doing rather well, because I make at least 3 or 4 every 10. So
to me, you always learn by your mistakes, and therefore you've not got to be afraid of making mistakes, because you will. Everyone makes mistakes. So this was one of ours. So it's a company that I've known for decades. As you say, they're probably the UK's market leader in providing technology to schools in the UK. And they have a number of divisions. As you say, they've got a division that does online exam marking. They've got a division that provides technology to schools as a managed service. And they've got a division that provides classroom teaching aids to schools. Now, this was a good example of a company that had a very, very strong balance sheet, that used that balance sheet to acquire a competitor. So TTS, which is their classroom teaching business, that's the brand name of the core classroom teaching business, and that's the market leader in classroom teaching. They bought a business called the Consortium Group from the old Smith News. It's basically the newspaper distribution company of W.H. Smith News. That they were going to consolidate the market, and they failed to do that. And RM bought a few years ago now that Consortium business. So you had the number 1 and the number 2 players in the classroom teaching aids sector under the same roof. And they went from a net cash position to a net debt position in that transaction. Very accretive to earnings, upgrades. But you mentioned the ERP, Enterprise Resource Planning software. So the software that drove the warehouse of the Consortium Group and TTS, they were going through an upgrade cycle, and they cocked it up. But basically, I think that's fair to say. So at one stage last year, they couldn't bill their schools. So they sell these products across primary schools and secondary schools across the country, and it was typically on every week the school secretary would order some more, whether it's a kind of a skeleton that teaches biology or whatever, or a book.
They couldn't get the invoice out.
They couldn't get the invoice out, and that was very problematic at a point when the company was in debt, and it was breaching its banking covenants. So it was in need of cash. And we took the view after we had a meeting last, I think it was last autumn time. I could have got the date wrong. They came out with a statement saying that they'd fixed the problem with the ERP, but the schools were not buying to the same volume as had been expected. And that really worried me that that school secretary thought, well, sod this excellent service that we've been getting from TTS and Consortium for many, many years has the disruption to that service has caused me to go and buy elsewhere. I could go and buy this stuff from Amazon, and Amazon was always that kind of threat of a competition. And so we took the view that more funding was needed for that business. We dislike debt. And at the time, debt was going up in terms of the cost of debt and the actual debt. And therefore, we sold our holding. And I think literally, it was a day or two after we had I'm not sure I should say this, but we had one of these insider information where someone wanted to build a stake in a company where they
Richard Staveley, probably from Rockwood.
I don't know who it was.
No, I don't know either, but I'm just guessing.
They offered it was something like a 20 or 25% higher price than we'd just sold out at. To buy a stake in the company. So our timing was awful.
Yeah. It wouldn't be Richard then in that case.
I don't think it was actually. I don't regret it because I think that the core worry I have with that business remains that the schools have not bounced back to the extent that we'd expected. Now maybe that improves and the damage done is repaired with good customer service and saying we can bill you now and it's better. But when you're breaching your banking covenants, that's quite tricky, which goes back to one of my earlier points that we like companies with strong balance sheets. Debt is very tricky, and that one of the things to avoid at all costs is companies that have too much debt. If you look at our fund in total, the average holding has no debt at all in our portfolio. So the average holding has net cash forecast for this year. So to me, avoiding debt is quite key to.
I mean, it gives you lots of downside resilience, doesn't it, for the actual business? And the other sort of key point I think is if a company you've invested in says they're going to do a big ERP upgrade, ask them how they're going to do it, because I understand this was on a big bang basis. They decided to do all in one every single site. And typically, I mean, I've done a SAP ERP. This was a long time ago. And you choose the least risky part. You go for your nominal ledger, your accounts payable in one site first, test it out, and then roll it out. You don't do your sales ledger first thing, lock, stock, and barrel, because if your AP goes wrong, then okay, you can't pay somebody on time, but you'll get it sorted. Whereas if you can't invoice, you got a problem. Okay, well, let's just move
numerous examples of that over the years.
Yeah, I know. There was one company's got a bit of extra debt is Videndum, which does high-end camera systems, and obviously was a beneficiary in the COVIDs when we were all locked down because people wanted sort of professional equipment to be able to do, sort of pictures and videos and all this sort of stuff. And then I guess they also got hit last year or just recently by the actor strike and the director strike out in Hollywood last year. Can you take us through this one, because it does have it's a bit of a sort of like reduce your debt balance and get the business sort of back to its lean, mean fighting machine, I guess.
Yeah. So this is another example that I would use of a mistake of ours where debt has cost us a lot of money. So the companies, they have a number of areas, but one of their key areas is offering camera technology to the Hollywood film studios, the likes of Netflix, etc., Disney, to allow high definition pictures to be taken back and forth when you're on set and off set. They do camera stands. So a lot of that business is predicated on providing a service to Hollywood and the kind of offshoots of Hollywood. And as you say, Hollywood went through this horrible strike action for quite a few months last year, at a point when Videndum had quite high levels of debt. So the chain of if actors and more importantly the writers are on strike, you haven't got a new Netflix series coming out. You don't need all that film kit and technology to be ordered. So their revenues went down significantly, and it was a question of when will this strike be over so that we can bounce back and people can get buying again. And I think it was something like the shares fell from £9 or £10 a share to, I think they did the refi at between £2 and £3, something like that. So
yeah, 267.
So that I think they raised over 100 million quid, but we would have preferred them to raise more and completely take away the risk. Not one, you can never completely take away, but reduce that risk of being subservient to the banks. So it allows you more wiggle room should it take a quarter or more longer for Hollywood to get back into the run a day ordering patterns. So that's one where we retain the holding because there's this bounce back ability. Yeah. But it's a heightened risk because you've still got debt within the company, and they only raised. We thought they should raise more.
Yeah, I mean, I think the latest word on the street from Disney is that it's concentrating on fewer large, big blockbuster films going forward in its slate, but Netflix is still going gangbuster, so it's a bit of a mixed bag. The one thing I would say, actually, which has only just come up this week, which is quite, I mean, it may mean nothing, but if I don't know if you've seen that Sora AI text video new application from OpenAI. It is absolutely incredible. You put a paragraph in and it will basically simulate that what you've said in a video, and it's outstanding, absolutely outstanding. I mean, obviously they've sugarcoated it and showcased it, but they haven't released it on general, and they're not selling it because it's so powerful that they're worried that it's going to start influencing the politics for this year. But if that does go, then it reduces a lot of filming, which is going to require, because you can just write your script and it will create it. But hey ho. Okay, right. We've got the final one is LBG Media, which I don't talk about very long. It's basically a global leader in youth publishing. I think it's Lad's Bible. Very cheap, good solid balance sheet, and I think what it does is help broadcasters and marketing to get access to this quite difficult to access demographic in sort of like, you know, your Gen Zs and your millennials and stuff, both on a creative side, creating content, but also effectively getting the website. It's got its own website and has lots of followers and helps people sort of target, I guess. What's your latest on this one? Because it's pretty cheap actually, but the whole of the media sector it's on about 7 times PE. Oh no, sorry, it's on about 11.5 times PE, about less than 8 times EBIT, but it's got 17 million of net cash. I think it just bought somebody out in the States actually.
I love the way that you've picked 3 of our worst investments.
Oh, have I? Sorry.
We talked about, but no. So this was an IPO of probably 2 or 3 years ago. When what we liked about it, as you say, they are, I wouldn't say the market leader, but they are a global leader in capturing a social media youth market. And I need to be careful what I say here, because I hope my daughters aren't watching this. They're going to be saying, "Dad, you're talking out of your bottom again because you're too old for this kind of stuff." But they basically reach through the likes of Facebook, Instagram, TikTok. They reach hundreds of millions of followers, and they serve them advertising, which is paid for by, if you sit through a minute or so of the advert, then that clicks a payment to them as the provider, and also they get corporates advertising as well. So it's the biggest client is the social media platforms, but they also have a corporate advertising. It's quite difficult to reach that kind of 18 to 25-year-old.
Well, they don't watch telly, do they? Or listen to the radio. It's basically,
so that's quite golden for a corporate to advertise to. So it was billed at IPO as a very fast-growing media company. Since then, they haven't really lived up to their fast growth meta. The growth has been poorer than forecast, and I would say this is another company on the kind of wait and see if they can do what they say they can do. In theory, they have a vast market where they are a leader, and the trick is how to monetize it in more ways so they can build a more diversified revenue stream.
Yeah.
So we've retained the holdings because of that potential, but so far we've yet to see them live up to their pitch, if you like. Yeah. So it remains a modest holding in the fund, but I think it's in an interesting area which could lend itself to huge growth. But
well, it certainly. It certainly could do with a re-rating. That's for sure. If it gets a re-rating, then it'll significantly and it deserves to, I guess. Just before we've sort of finished, is there any stock you'd like to sort of mention? Because I don't want to go on three duds or three ones which have been a bit more problematic. I mean, the other big ones you've got are Eckoh and Money Supermarket came out. I mean, Eckoh's done pretty well over the last 3 or 4 or 5 years, hasn't it? On its turnaround. I think they have that Soames guy he was the grandson of Winston Churchill, wasn't it? What would be something you'd highlight as a good example, just to finish on?
Oh, well, I think we've talked about many of them. I suppose when we look at our top 10 holdings in the fund, and we've talked about quite a few of them, Mears, Hollywood Bowl. We have a lot of market leaders in their niche. And that, to me, is very important because we've gone through this inflationary period, inflation's now coming down.
Yeah.
But from my experience, wage inflation is harder to cut. So whereas everyone had pricing power last year and the year before, not everyone's going to have pricing power this year, but you've still got national living wage going up 10%. You've still got that. People need to companies need to put their prices up this year by whatever it was, 5%, 3%, 4%, 5%, in order to cover off that wage inflation. And otherwise, their margins are going to be or their absolute profits are going to be under pressure. Market leaders tend to have better pricing power than others, in our view, and so the majority of our top holdings are market leaders in their niches, whether it be Dunelm in furnishings, Hollywood Bowl in 10-pin bowling, H&T in pawnbroking,
Wilmington
in training compliance offices,
yeah,
as these tend to have much better pricing power. And when you couple that with companies that don't have any debt and the fear of recession being overblown, to me, that marks for quite a good outlook. I mean, I come into the office every morning and there's half a dozen share buybacks for companies that we own shares in each day. I've been doing this for 35 years. That's never, ever happened to me before.
You're right. No, I would agree. And also, not only buybacks, but there's very few director sales.
Absolutely. So to me, the companies are saying, in doing share buybacks, the companies are saying that they're confident in their future to give capital back. They've got too much capital, so their balance sheets are strong, and their share prices are low, so that they want to buy more of it. So that, coupled with, I mean, we've had 27 takeovers in the last 5 years at an average of over a 50% premium. So to me, you've got the companies buying their shares back themselves. You've got the companies themselves getting taken over by other bigger companies, and you've got the management still pretty confident. There are pockets. We've talked about tech being still under pressure in pockets, but generally, companies are positive about the future. So we're thinking this is a great buying opportunity.
Yeah, I would agree. I think concentrating and focusing on companies with niche positions, plenty of pricing power, strong balance sheets, not haven't got much debt or in positive cash positions, and with sort of like attractive valuations, then yes, if they can trade, they'll trade, and you'll get a re-rating and improve profits going forward. But there's more than likely somebody else is going to run the slider all over them and take them out. So my prediction here, Mark, when we speak in 6 months' time, you'll have at least 2 or 3 more M&A acquisitions or takeovers, I think, on your portfolio.
It seems to be the way. I was listening to you highlighted some of the previous speakers. I was listening to Gervais talk about some of the takeovers and not being happy with the prices that
yes
be given. I would absolutely echo that sentiment. Some of these prices are so depressed that even a 50% bump isn't making us particularly happy about it. But when everything else is so depressed, we can reinvest that cash. So we've just got the SCS. So SCS is a sofa retailer that's taken over by an Italian competitor at I think it was a 60% premium. Still, it wasn't a great price, but we can reinvest that in other things that are all equally cheap. So there's that kind of silver lining, if you like, even though we're not happy with the price that we're being offered.
Reinvest. Okay, good. If somebody wants to invest in yours, in this sort of UK smaller companies fund for Artemis, or any other sort of like Artemis funds, how best to do that, Mark? Is it sort of like go on your website or through the usual sort of channels of AJ Bell, Hargreaves Lansdown, or
I'm not sure I can give investment advice, but I suppose speak to your financial advisor. Have a look on our website. Certainly Will and I have interviewed quite a few of the managers of companies that we invest in, and those interviews are on our website. So certainly GB Group, Mears, Fuller's, Wilmington, interviews with the executives running that company on the website that gives you some more colour, if you like, which might add to some of the stuff that we've been chatting about.
Well, I'll definitely have a good look at those, Mark, and many others as well. So thanks again for your excellent insights and time. Really great ideas there for people to sort of go away and doing a bit of research. So thanks again, and look forward in touching base in 6 months' time.
Lovely. Thank you very much. Appreciate it, Paul. Thanks.